Hello, Warriors. How's everyone doing? Raj, Alexander, Hugo. Everyone doing okay? Next couple of days are going to be very important in the markets and equities. Hiya, Jays, Sinatra. Also, we're getting closer to hitting targets in the yen, about 112.50. A little bit too much momentum, so it's going to have to do some work. Hello, Michael Schneider. How are you? Dixie continues to move along, relentlessly confirming this high. So just from here to here gives you 95. From here to here almost gives you 97. Oliver, how are you? And I'm thinking that if the yen is going to put in a top up here, and it's going to be pretty classic, that it's going to be most likely because of risk off. The DSI is very overbought, although they show the yen the other way. So it's, there's only like 10% yen bulls. And that's when it's yen US dollar instead of US dollar yen. You guys know that, it's priced differently in futures, the other way around. So that looks important. Pretty negative week in the euro. We're probably headed down. Look, we're right at that 200-day. That's a week. 200. What a bad week. 200-week moving average. I think we're going here. 113. So not diverging yet. As strong as the dollar has been, I'm really not that impressed with what Canada has done, So we'll see if it could finally kick into gear, or we're building some type of maybe head and shoulders, left shoulder, head, and a right shoulder here. That could eventually take it down to 22 again. It's one of the weakest. Swiss has been pretty strong. It's diverging. Not ready to fade that yet either. The dollar wrecking ball is coming to pass. Let's see if it wrecks it, Ben. We've gotten a little bit of a break, about 5% break, and Nasdaq hasn't wrecked it yet. Nasdaq starts closing back under 14.4, 14.5. Then I think it's the demolition is underway. And let's look at the gold. So when the yen gets up there, that may mean a temporary halt in yields, and also might be able to look at something from the long side in gold once US dollar yen peaks, which I don't think we're there yet. Who's with me today? Stella and Ryan here?
Ryan is not here. Blake isn't here. I'm here, and I think Greg is coming too.
Greg is coming in. So, okay. So how are you today, Stella?
I'm very well, thank you.
Good.
Everything's good. Just watching these markets. Let me take the screen.
Sure. Silver had a pretty negative day yesterday.
Yes. And it was one of those days where there was really very little reason for silver to underperform gold that much. Gold was marginally lower and silver was down 4%. What was it? So it's one of those, it's one of those days when it just gets pounded badly. And personally, I think it's great opportunities to slowly start getting some more in. So I got a little bit more of one of my favorite ETFs to get long, but still I'm less than half the position that I really want to have. So I'm
SILJ.
No, I actually got PSLV, which is the Eric Sprott one, which is 100% allocated in physical. It's not a minor ETF.
Oh, okay.
It's silver, yeah.
Okay.
And but anyway, slowly does it, and you have to be controlled. You have to be disciplined, and I'm running very, very low leverage. So,
okay.
you know,
And you have been disciplined because the stellar chart you have up with a 96 target has been up all year.
Yes, and you know, we've been talking about these two fibs, the 38.2, which is I think 94.47. So basically where we are now, and it could go up to 96. And remember, we've been talking about it even on this little rally at the end of 2020, beginning 2021, when you know dollars showed some strength, and we were saying, look, it could get to 96. It would be a great selling opportunity. It didn't. It went right back down to 89. Now it's trying again, and you know, Blake has been saying it for a while that you know there will be times when you have to be bullish a dollar. He has been bullish a dollar, and it's been a very good call. And this run could continue. And you know, as this continues, then stocks become a little bit nervous. Metals go lower. Commodity currencies obviously suffer a little bit, and the dollar keeps going. The question is, you know, what's the end game to all this? And by end game, I mean, you know, weeks, months, years away. And I think that in the long run, the dollar is going lower. End of story. But in the short run, it could get up to 96 and the DXY, no problem at all. And that will shake out quite a few people because remember, a few months ago, everybody was bearish the dollar. A few weeks ago, you know, a couple of months ago, everybody was bearish the dollar. And oh my God, yeah, DXY is going to 50 or whatever they were saying. And you know, whenever you see the market going one way, it's most likely it's going to go the other. You know, price is going to go the other way. So I still think that this is going to be the path for the dollar, but you know, there's going to be some pain first, and we have the U.S. government trying to avoid you know, they have to increase the debt ceiling because otherwise things will not be able to get funded. So that's what they're going to do apparently today. And I'm reading on, I think it was Bloomberg, who were saying, look, you know, they have to agree in order to avoid a US default. And come on, the US will never default. You know, this will never happen. Obviously, no, you know, I'm not going to say never because nothing is 0% chance, but come on, the US are not going to default. So what's going to happen is they're going to increase the debt ceiling accordingly. They're going to, you know, mint the $1 trillion coin, do whatever they need to do. And what they're going to do is they're going to just keep inflating the debt away, you know, keep debasing the currency and move on to the next administration and the next Fed chairman, the next president, until one day something happens. I don't know what that's going to be, but I think for the moment, they're just going to continue doing what they've been doing for decades. So, you know, for me, I think, you know, that's the big picture. And the thing that everybody's looking at now is clearly yields, the dollar and yields, basically. And, you know, people are saying, oh, yes, yields are going higher. But, you know, I always like to take a bigger, you know, a longer term view on things. And look, we're in a massive downward channel and we're still in it. And yes, you know, yields have gone from, you know, 40 basis points, 10-year yields from 40 basis points to 150. And, you know, clearly markets move and, you know, you can make money on these moves. But I think we're still, you know, the big picture is we're still in this channel and you know, I don't see the big picture having changed. I've said this before. I think above 170, which is probably going to be the 200 weekly moving average, somewhere around there is going to be crossing. That's going to be a big point. But you know, 2% will be the big one if we cross 2%. You're going to hear me saying very different things. So you know, yields still within a broader picture, I think, still going sideways. And look, we're now in this, we're trying to break out of this area, which has been quite significant in the past decade now, this 10 years, right? Yep. So yes, COVID caused this, or actually it was before COVID, but still it you know, it started before, and COVID was the, actually, no, it was COVID. Yeah, there it is, March. So COVID caused this. Now we're back. And we seem to have handled, I want to say handled, but you know, whatever word you want to use, COVID is being handled with vaccines and with everything. So we're slowly going back to normality. And look at yields. They're going back to where they were before, actually near the lows of where they were before. So, you So that's that's what I think about yields. And then you have S&P and equities, which are really the only asset class, in my opinion, that is accurately reflecting the change in monetary supply that we've seen over the past years. And it's no coincidence that, after 2020, when we saw this huge, look at this, it's not even 45 degrees, 60 degrees. We had the drop, the Fed and every central bank in the world threw the kitchen sink at the problem. They're just, inflating their balance sheets. They're doing everything they can. And I think stocks are the only, asset class that's reflecting this. And we have to remember, definition of inflation, the original definition of inflation is a change in money supply. It's not the basket of goods, CPI that we're used to talking about. And if for me, in real assets, and you have to remember equities are also real assets. They have, the companies, they have buildings, they have operations, they have products behind them. All these things are going to get revalued to the upside as the dollar loses purchasing power at the end.
I was thinking of Ben Maldonado when this scandal broke out at the Fed, because part of his narrative comparing this to the 70s was that the Fed, that we were going to become decentralized and the Fed was going to be under attack. It was a self-inflicted wound, pretty much, with those guys trading. And really, I don't think there's been a time in history that so many Fed officials are going to be replaced, including most likely the chairman going into next year. So there's some, the Fed is definitely, and not because of, how they've handled the economy, but because of ethics, has certainly taken a knock on their reputation. So Ben, good time, loss of faith in institutions. That's what you were saying. So that's sure made me lose some more faith that these guys could, just go in and buy mortgage-backed securities, knowing the Fed was going to come in behind them. And even Paul, he thought he was safe. He owned muni bonds, but after the COVID crash, the Fed came into muni bonds too, munis,
yes,
corporate
they're
junk,
buying everything. Yeah.
So, he got bailed out on his position too.
Yeah.
So,
and the question,
anyway.
the question, yeah, you're absolutely right about that. I think we've all lost faith. But the other thing I want to say is the question about what can a central bank do with inflation the way it's rising now. Obviously, it's a different kind of inflation. It's not demand-based inflation, but it's driven by supply problems. But people compare today's problems with the 70s, and I'm like, you can't do that. The Fed could easily hike rates, from 2% to 10%. And it wouldn't be such a huge issue now. And why is it a huge issue now? Because everything's so leveraged and the debt is so high. And the main reason why asset valuations are where they are over the past 10, 15 years is easy money, zero rates, and the Fed buying everything. So they cannot do what they used to do 20, 30 years ago. That's the problem. So they can't come in and raise rates to 5%, 6%, wherever they should be raising, because they know it's going to be carnage. So they're in a corner. And they're saying it's transitory, and they're trying to hope that this problem will go away. And maybe it will, maybe because of these supply issues, eventually it's going to get solved. But until then, I don't think there's much they can do, actually. Anyway, I think we have Grega here.
I saw he's in.
Are you here, my friend?
He's in the room.
Yes, I'm here.
Hello, my favorite Croatian, no, I'm kidding, friend.
I heard there's some things happening in Slovenia, some big protests.
Yeah, really? Probably they are happening in a lot of countries, but I'm not sure if we have so many reports in the media. Probably not. So
I saw it. Well, that's where I saw it. I think I saw it.
Yeah, it was around 20,000 people, I guess.
Yeah. Were you there?
No.
You were doing.
I was not there.
You were charting what if they were in a corrective or they were being impulsive being out there?
Protests are definitely an impulsive structure.
Oh, okay. You're probably right, buddy.
I'll give you the screen, Grega, if you want to take it.
Yeah. I cannot see
Share screen.
It's on the bottom. It's a green button at the bottom center.
Okay, I have it now. So I will actually look at the Aussie dollar. Okay, I just think that this Aussie can become very, very interesting from both technical perspective. We have a lot of massive shorts moving into some of extremes. There will be a lockdown removed, if I'm not mistaken, on October 11th. And based and compared to the past price action from 2020, when we also have seen these removed lockdowns in the same period, that's when actually Aussie dollar took off. So I'm looking and observing two wave counts for Aussie. But before we go to the smaller time frame, let me just revisit these higher degree time frame charts. So if I'm not wrong, Dale, I think we covered this one in the past as well. So I'm looking here for significant recovery on Aussie dollar away from recession lows. It was a move in three waves back here from 2000, then 2008, also in three waves. And now I'm expecting something similar from last year. And so far, I can see only one leg up from the lows. And currently, we are just pausing here this recovery that I believe will resume. Now, looking at the daily chart, I'm tracking actually and observing two wave counts. Now, the first one is that from last year lows, move is impulsive. Okay, that's wave A. The only question is where this wave B will finish. I can see here on the right, on the left, potentially we are bottoming, but still we haven't seen an overlap with this wave A level. Now, for those who are familiar with the Elliott waves theory, will know that whenever we see an overlap with that wave A, that's usually a signal that maybe bottom is forming. So far, that's not been the case. So that's why I'm also looking at the second wave count where I'm tracking potential 5-wave drop. But what's interesting based on a time perspective is that even if I'm looking here on the 5-wave drop to be part of this wave B, well, after these 5 waves, still we would expect a rally, but limited upside. So based on timing, I think that it can be very interesting for potential supports here on Aussie. I can see also Aussie against Kiwi turning quite sharply to the upside for the last week or so. So in my opinion, this Aussie will bring in more attention, especially if sooner or later, again, stocks will try to stabilize. And as I said, also, we have the COT. Let me share this chart, which is here. Okay, so you have here the COT data. You can see that there are a lot of massive shorts here going on, and something similar, or even now we are a better extreme compared to back in 2020. So again, if we consider that, especially based on Elliott wave principle, if something is moving into some extreme levels, then we know that sooner or later new cycle should occur. So in my opinion, we are still very close to potential support. Of course, 0.7 psychological level is something we should definitely pay attention on if we see a new dip from current prices. Now, let's take a look also on copper. Now, copper is also have it here. Copper is also moving sideways and potentially building here a corrective movement. Maybe it's a triangle. So if we are going to see more sideways, and then let's say in the next few weeks, this broken trend line, then I think that this copper will continue higher out of this consolidation. Clearly, we have a very strong recovery here. So I definitely do not want to call any top here. So in my opinion, there's a chance for copper to continue higher. And whenever that's going to be the case, that's when Aussie dollar could again be very interesting. That's one thing. And then you have also here Hang Seng Index, okay? Firstly, let me look at the higher degree timeframe charts, okay? So here's a very interesting cyclical approach. Since 2008, when we have seen market coming sharply to the downside, it has bottomed after this 40 to 50 weeks of a pullback. It has been the case here after 2008 crisis. It has been the case in 2011. It has been the case in 2016. We have also since recovery here after this drop in 2018, again 2020, and now you are again seeing a very nice retracement, which still did not fully complete this cycle, but it looks like that we are moving into these final stages of the current cycles compared to the previous price actions. You have also very important trend line down here. So I think that as long as we are above this trend line, there is a chance for a rally, even if just short term towards the upper side of this triangle range that I'm tracking from an Elliott wave perspective. So overall, I think that this all builds quite an interesting potential base for Aussie dollar, which I believe that sooner or later will again catch its own beats from the current near-term levels. Also, we have some crosses that are very interesting. If we, for example, let's take a look on Euro-Aussie. Now, Euro-Aussie here is definitely in downtrend after 2020 peak. And we are just now trying to stabilize just a little bit here at this trend line support. But looking at the daily chart, okay, notice that this rally appears to be quite overlapping and choppy, especially if we consider the previous very strong drop. And recently, what is the most important is that we broke this trend line and retested it from the outside. So at least in the short term, it looks like that we could go a little bit lower and maybe take this 1.59 level out, which would obviously open or make a room for much lower prices. Also, if we take a look on, let's take a look on pound Aussie after this gasoline crisis in the UK, I think that maybe this can be even more interesting. Here we also can see in the monthly charts a few breakdowns out of these channels, and the recent one just occurred here also on a daily chart, where we, same like on Euro Aussie, we have seen a retest of these trend lines, and now we are trying to move to the downside. So I think that even if this is going to be a free wave drop, like an ABC, well, there's still room for more weakness. Also, I have here Aussie yen. Well, Aussie yen on a big scale, it's trapped in the range, and this volatility will likely resume in both sides. But at least in the short term here, I think that there is more upside potential. After this breakout of this bullish flag, we retested the trend line, now trying again to recover. On the 4-hour time frame, that's probably the most important. You have 5 waves up and a 3-wave setback. Of course, the current situation on stocks could be a little bit concerning here regarding the bullish outlook for ASEAN, but let's assume that maybe today and tomorrow we see stocks stabilizing and maybe even try to produce some gains. Then I think that for the next week, this ASEAN could be very interesting for more upside. Now, break above 80-90 will clearly suggest that we are headed lower and that market left only 3-wave drop corrective movement behind it. Also, let's take a look on metals. Now, gold, clearly here on a monthly scale, it's trapped in the range. So for now, we should stick with a higher degree trend, which is still to the upside. Notice that we are trying to build a base here at the 38.2% of an extended wave 3, which is typical perfect fib level for a wave 4. But usually in these sideways consolidations, well, 4th wave can be quite complex. So I'm tracking 2 interpretations. The first one is, if we just stay sideways here for the next few weeks, is that we are in the middle of a triangle in a wave 4 here. Okay, and here, then you would expect a rise into wave T back to the upper side of this triangular range, but still ongoing consolidation. So that's why we have to also keep an eye on the second one, where I'm observing potential wave B triangle of a wave 4. But what's the main point is that in either case, I see these pullbacks from last year highs, from last August of 2020, as a counter trend movement. The only question is when and where this correction will complete itself. For now, it's just too soon to say that we are in the middle of a triangle, but I think that we may get some kind of answers next week. I'm here observing potential corrective setback from that 1830 area. Notice that we can count this as an overlapping 7 swing movement. Also, if you look on the intraday chart, you have some potential wedge here going on. So maybe in the short term, we get some kind of a recovery, but really key point for the bulls, at least in the short term, would be this broken trend line resistance. In such case, I would be looking for much more upside here, probably towards 1860 if we can recover above or towards $1787. Now let's take a look also on silver. Now silver on the long-term charts still looking to be in a corrective formation. Now from a cyclical perspective, I mean, a lot of assets were overvalued. They are at extremes. It's very tough to find any interesting levels for, especially for long-term investments. So maybe traders, investors will try to focus now on silver, because we are, after all, consolidating on this one for quite a long, while the others will keep outperforming. So I think that this one, again, could bring some attention in the next few months. We are at a potential support line here around $21, where it was a peak from 2016. And let's not forget that rise from last year lows is in 5 waves. Okay, and always when you have this 5-wave movement, well, that's the trend on which we should focus, especially after a completed 3-wave contra trend movement. So I think that we are now trying maybe to stabilize here. We just spiked here below September levels of last year. So actually you are at the same level a year later. And in flats, what's very important for them is that you see just a temporary movement beyond wave A, very similar for wave B that occurred here back in February. So when we also have seen a failure break to the upside and then a reversal. So I'm looking for something similar to happen down here, and especially if we consider, as I said, that previously we have this 5-wave rally here for wave 1. Also, let's take a look now very quickly on crude oil. Okay, so crude oil is clearly very bullish. I will be looking for much more upside after any pullbacks, but looks like that in the short term, we just should be aware of potential limited upside. Well, you are now here at the 2021 highs, retest of the highs. So if we try to build a double top here, then of course, just be aware of more weakness as long as we are below that level. Keep in mind that that's the same area like we have been here in 2018. So definitely very important region. And if we consider that previously we have these 5 waves up, or that I could even label maybe as an alternate scenario that this was wave 4, well, you are then now in a 5th wave or wave B of irregular formation. So in either case, after such a strong recovery, you can expect market to slow down for a little bit longer period than just this one that we have recently seen. So I'm afraid that we could be stuck in the range here and that we will not complete or continue straight to the upside. Also, you have a very strong divergence here. We just, when we have seen a rally, we just hit this trend line here on the divergence. So it's interesting to see this current bearish turning point. Also, notice that this rise is still trapped between these 2 trend lines. So this price is still trapped with between these 2 trend lines. So in my opinion, this can be seen as a corrective wave B. Okay, so just be aware of potential slowdown. I know that there were a lot of interest on the long side of crude oil after recent events. So I'm afraid that something.
So could C travel down to 60, Garega?
That would be ideal scenario, yes. I think that, as I said earlier, either if we are in a 5th wave, we would again expect a pullback to the former wave 4, which again would be around 60 area. Or if that's going to be a flat, that would be, again, a very interesting zone. So overall, I'm bullish on crude oil, but I just think that we could face some kind of a retracements here, or at least stuck in this bigger range.
Fantastic.
Great presentation.
Thank you, Gregor. We have David today, right?
Yes.
Excellent. I really like him. Looking forward to it.
You like him more than me?
Yeah, you're my number one. You know that.
Okay. Hey, Gregor, thank you so much for coming in today, buddy.
Thank you, Gregor. Thank you very much.
Some nice looks, because I think, have you noticed, Greg, a lot of people are kind of confused with what's going on here. You know, the dollar surprised them, and metals sunk, during an inflationary environment. So there, a lot of people have a muddled picture, hard to have a lot of conviction. And look, you've been tested too. You liked Aussie, and, and you're finding new reasons to continue to like it for a different trade.
Yeah, so, and I think we just have to be patient. The markets never respond or unfold as when you expect. I mean, you always need.
There've been a lot of disjointed kind of moves. So thank you, Wizard, for being with us today, and good hunting the rest of the day. I know I appreciate your work, being able to go to the Forex Analytics website and check out what you're thinking. So keep it up, bro.
Thank you, mate.
All right. So we have David Keller back with us. David is a pro. I'm going to be very interested in hearing what David's thinking after the action that we've had. David?
Good morning, How are you?
Good, buddy. You're all over the place. You're on Traders Summit, you're on Forex Analytics, you're on stockcharts.com. You do happy hours and talk about the markets. You're prolific, and
I'm doing what I can.
Yeah, trying to give people some guidelines and areas to pay attention to. What's on the radar here, David? Has this week's action, the last couple of weeks' action, created any kind of ripples in your work for the bull case, now that they're starting to rotate out of mega cap growth a bit, and with the move we've had in yields, people have moved into banks and cyclicals? Okay, so here's the S&P. Start with that. Okay.
Absolutely, and you summarize things beautifully there, Del. I think there are times when we do what we do as technical analysts, when things seem sort of routine, and you're sort of hunting for themes and trying to find ways to differentiate stocks. And I don't feel like this is one of those times. I feel like this is, it's never easy, but this is about as easy as it gets in terms of recognizing that there's a change of character. And I always talk about markets as evolving in a series of what I call changes of character, where conditions are a certain way and then they change. And I think regardless of what your long-term point of view is, in the last month or two, it's hard to deny that we've seen just a huge rotation, right? You've seen stocks in general being from a consistent uptrend to rolling over in a lot of ways. And whether it's the Nasdaq 100 clearly breaking, a support level, the S&P sort of testing it, the emergence of small caps, the emergence of some of the cyclical sectors, and all of this in the context of metals going lower, interest rates going higher. We could and should hit on every one of those charts. But the S&P 500 is a great place to start. And I was taught early on by one of my mentors, Ralph Acampora, if you know nothing else, just look at the chart of the S&P 500. That'll tell you most of what you need to know in terms of the equity environment. And the way that I'm seeing the S&P is as such. We've had an incredibly consistent and incredibly persistent uptrend through the course of 2021. And we've all gotten very comfortable to an incredibly consistent pattern of the S&P making new all-time highs every month, the S&P pulling back to its 50-day moving average and rebounding beautifully, the RSI coming down to 40, which in a bull market phase is pretty much classic bull market behavior, where you become overextended when you have the impulse move to the upside, and when you pull back, the RSI remains above 40, and that sort of suggests that buyers keep coming in and propelling prices higher. All of that has changed here in the month of September. She made a new all-time high in early September. we've now changed the character of the market, right? We've made, instead of, making a higher high, we've actually established a lower high in the last week. Instead of bouncing off the 50,
all the way up,
we actually
right?
broke through the 50-day.
Yeah, isn't you look at that whole trend, and every pullback after the pullback rally to new highs, this is the first failing rally you could see all the way up, isn't it?
That's exactly right. And what's great about a consistent support level like the 50-day moving average is a lot of people key in on it. It tends to work, and it's really, really good. Greg Morris, another of my mentors, always said all new highs are good except the last one. And I think maybe in early September we've seen, at least in the short term, we've seen the last one for a little while. And that's the problem, right? Is the challenge is, now that we've broken the 50-day moving average, what next? And this level of support that we've all been counting on, that will continue to indicate where to buy on the dips. All of a sudden, this last time was not a good time to buy on the dips so far, because we're sort of rolling over. And I think, to summarize, what you have to remember is this sort of pattern. If you call this a head and shoulders top, which is a high surrounded by two lower highs, so it's a classic pattern. A head and then the two shoulders. If we break the neckline, which we've arguably done this week, it depends on how you draw that in those interim lows, but we're pretty close to doing something on the Nasdaq, especially. I think we've already broken that. What you traditionally do is take the height of the pattern and subtract that from the breakdown level, which means if this sort of plays out like a normal head and shoulders top would, that really only measures down about another 5-6% lower. That takes us down to around 4,150, 4,100, which would be down to the 200-day moving average, which is about a 38.2% retracement of last fall up to the peak that we made in early September. So it's not a end of the world move, but it's certainly we need more pain before we resolve to the upside kind of move.
And that would be what people will be saying then, I'm just guessing, garden variety correction, 10%.
That's exactly right. And what's interesting is, in 2021, a garden variety correction or a pullback has been 3 to 5%. That's what we've gotten very comfortable with. A 10%, 12% drop is going to feel like a climactic end of the world. It's actually very orderly and fairly common if you look back at bull market history for decades in the market. We just haven't had one of these in quite a while. But I think what would happen, in my sort of base case, is we pull back further, we get down another 5 to 10%, which would take us around to the 200-day moving average. Maybe 40-50 is the 38.2% retracement. That's the time when I think you'd want to start thinking a lot more risk on, because there's so much strength that we're seeing from the cyclicals, so many themes, small caps emerging. There are a lot of things that are more longer term themes, infrastructure investing, that's all going to, I think play out into next year. This is giving you potentially a much better entry point for that.
Okay. I noticed one was a big down day, Tuesday, that there was nowhere to run. Metals were down. I think crude wasn't doing much. That's been one of the strongest bull markets out there. The metals were getting creamed. Bonds were going lower. There was nowhere to go. And I said, well, there is something called cash. So is that kind of what happened? I mean, there was nothing to buy. You couldn't rotate into another group. It's like kind of a classic swoosh in all asset classes.
Yeah.
Do you think that's just like, kind of a harbinger of things to come? As long as the dollar remains strong, we have a guy in here who calls the dollar the wrecking ball for everything. So, I don't think the dollar is done yet. What's your take on what's happening with yields? We had that big rise, and that reporters said, well, that's why Nasdaq fell, because, mega cap growth, they don't like higher yields. I don't know what to, in normal times, I'd say, yeah, we're going to 2%. But if we're going to get a sell-off in equities, it kind of tempers how far I think yields can go. What do you think?
No, it's a really good point. And you hit, Dale, on cash. And it's funny, most, active management gets a lot of negative press because, especially in recent years, active managers as a whole in the equity space have certainly tended to underperform. And I think the biggest reason is because we've been in such a consistent bull market phase. And if you look at most active management, they tend to outperform. They tend to do much better in down markets because you can get defensive, you can go to cash. And you tend to underperform in bull markets on average, but outperform enough in bear markets that over time it's a much better way to manage. We haven't had one of those, and I think going to finding income, which is not in bonds necessarily, even though rates are coming up, it's still relatively low compared to places you could hide in the equity markets, places like REITs and others that pay a decent dividend, but also cash, and not being afraid to take bets off the table if the charts suggest that that's the case.
Could this be a cup and handle? I'm not real familiar with that formation. I usually call them head and shoulders, but could this be the handle developing here in 10 years?
So I'm going to show you a much better cup and handle. I could see
Okay.
the argument for like this big sort of thing, but the problem is what you really want there is you want a parallel. You want these to be at a pretty similar level, and we'll come right back to the yield chart. But I'll tell you, like the UUP is probably a really good visual of that. Here we go. This is what a cup and handle kind of looks like. A little shorter term, but you sort of get the pattern. So we have this rounded bottoming pattern. You come up to the same resistance level. It's sort of the base, and then you have the shallower pullback, and then you break out. So when you talk about the dollar going higher, every chart indication I would look at would back that up. It's sort of a classic pattern of a distribution pattern, and then this consolidation pattern, this basing pattern with a clear support level, a clear resistance level. We've now resolved that to the upside, and that suggests much further upside before things continue on.
The longer the base, the higher the launch into space.
That's exactly right. So yeah, the time that these things have spent, these have been multi-month, 6-month plus sort of basing patterns for the dollar.
Okay, and we had looks like a gap up yesterday.
That's right. Yeah, so it really is, John. Now, this is the UUP. It's the dollar bullish ETF. And I look at this a lot only because I have a lot of people that are making a dollar bet that way. But the dollar index is a similar pattern to this, and showing that base, showing the resistance, and showing the breakout to the upside.
Okay. That would take, if we did the same thing with the dollar, Khalid saying 97.65. Okay.
So the interest rates that you mentioned, I think, for me, the higher rate story, you're right. I mean, in general, when rates are going higher, the general things you can assume, and I don't like to think of it in terms of absolutes, right? That the interest rates going higher does not mean growth stocks are going to go down. It definitely provides a headwind for performance, and also provides a tailwind for things like financials. So if you look at the relative strength of the XLF, it looks pretty decent right now, especially over the last week or two, because of this rise in yields. And so, I've tended to think of things. I would hesitate. You'd mentioned how it's a choppy market, a lot of narratives, and gold's not going up when you think it might, given inflationary concerns. And I always remind people that those sort of intermarket relationships are not absolutes, as much as we'd love them to be simple relationships that we can bet on. I found they're a little more fluid, and you think of it more in terms of headwinds and tailwinds. Higher rates tends to mean certain things for financial stocks, tends to mean certain things for growth stocks, but I would much rather be looking at a chart of the XLF and the XLK and the Nasdaq to get a good read on how those stocks are actually behaving relative to the market conditions. And with rates, you're certainly seeing a higher rate environment. I think the cyclical stocks that performed so well the first half of the year almost, and then struggled really in the third quarter, are reemerging. And you're seeing strength in energy, you're seeing strength in financials. Arguably, I think the rest of the infrastructure trade, industrials, raw materials, I think you're starting to see those, we'll start to see those emerge a little bit further. And I was told, again, never confuse the top of the page with resistance, never confuse the bottom of the page with support, right? So rates, when you think, well, could rates go to 2%? I mean, they could theoretically go to 2%. They could go down to 0.5% again. I don't think that's likely, but it's possible. And so, the chart is clearly showing you that bond prices are coming off. It's showing you that rates are going higher. We're back in the range that we were basically in sort of that March to June timeframe. So we have a lot more upside. We could go to 170, even 180, and still sort of be within the normal range that we had from earlier this year. And I think that's totally reasonable here.
Okay. Looking at, I've been showing the community a lot of the Nasdaq stocks, and kind of building my case that I was, I don't know, about 3 months early on, David, and maybe about 3-4% in Nasdaq 100. But I look at things like Facebook, and it looks like a broken stock. I look at Apple, it looks like we had a rising wedge failure. One of the stars has been Microsoft, which gave up quite a bit of ground after being at 305. I'm having a hard time. I think the only FANG stock that still looks good to me for a new high is Netflix.
Yeah.
But Google doesn't look so good. I mean, you know, most of these stocks look like see, Netflix is only one, but you know, you look at Apple, it's come off pretty good from 158, and you look at Facebook is really kind of cratered, and it really hasn't done much for a while. So do you have is like a FANG? Is there a FANG composite chart that shows all of them?
Yeah, absolutely. It's we have an index called $FANG. It's the NYSE FANG Plus Index, and it's not just those stocks that you mentioned. It's sort of FANG and FANG-like things. So things like Twitter and some of the Chinese internet names and others are kind of heavy in this bucket together.
Pretty heavy. Right.
It is, and I think you hit it right on the head. You know, it's interesting that the one FANG stock that looks sort of strong relative to the others is Netflix. And for the longest time, that's been probably the one, maybe Amazon at times too, that have been the underperformer, right? The rest of the FANG stocks have done so well. And things like Netflix have actually been the laggards within that group. And you're seeing the tables turn a little bit. And to be honest with you, yeah, does the chart look heavy, especially in the short term? Absolutely. You know, on the FANG Plus Index, as you're seeing with some of these stocks, you're getting a bearish momentum divergence with index making new highs here and the momentum actually sloping downwards. Yeah. You're seeing that on some of these charts that have essentially been overextended. And I don't disagree with your take on things like Microsoft and others that they're just breaking down support levels.
I mean, that came out that really got creamed this week.
It did. And when I talk about a change of character, this is the type of chart that resonates, right? It's a chart that is clearly in one mode. We're making new all-time highs. We're consistently outperforming. The relative strength is going up and to the right. And then finally, all of a sudden, things start to change. And all of a sudden, we're breaking the 50-day. And all of a sudden, we're making lower highs and the relative strength is turning down. The momentum is really coming out of the market. And that shows you that things are changing. I guess what I would say and what I would hesitate to draw too many long-term conclusions on that is remember that distribution pattern that we talked about on the S&P. Here it is on the Nasdaq. This is that, head and shoulders top. This is a 2-year chart. And you can see that head and shoulders chart is a little tiny sort of rounding error type of pattern here in the far right corner. I think the long-term trajectory on these stocks is still very, very healthy, but I think there could be more downside before this is done here.
Maybe the 200-day and both the S&P and the Nasdaq are reasonable.
Yeah, from a technical perspective, the Nasdaq going down to around 14,000, or the Nasdaq 100 I'm looking at here, would make a ton of sense. And for a number of reasons, the 200-day moving average hasn't been touched in over a year and a half. But that in general tends to be a level that a lot of people would key in on. 14,000 was a key level earlier this year, if you remember, because we hit there a number of times and then finally broke above there in June, which was pretty significant. So it would be fairly reasonable to expect that to become a new support level. And also that's the height of the pattern. So with a pattern like this, you take the height of the pattern, you subtract it from the breakdown level, and that gets us right around to that same sort of level. So the base case I see for something like the Nasdaq, you pull down another, 500 points, which again is going to feel climactically negative. But if you look at the long-term trend, it's actually completely reasonable for a bull market phase to have that sort of pullback. We've been under corrected here for quite a while, if that's a phrase.
Could it be that the markets and risk on does not really get in gear again until UUP and some of the dollar index targets have been achieved and the dollar starts heading down again?
I mean, it could be, but I think it's also a question of leadership, right? So you have something like JP Morgan that's actually, just making a new all-time high again this week, testing resistance. A lot of the financials are doing that. Airlines popping up, right? So I'm not struggling to find stocks that are breaking down given the short-term weakness. I'm also not struggling to find stocks that are breaking out and testing resistance levels. It's just the names that are doing it are different than the ones you're probably thinking about. Just in, yesterday, you had a lot of names that were up significantly. And some of these names are ones that have been beaten down. It's like video games, EA and Activision and Take-Two. pretty good bounces. Now they've been struggling for quite a while. So it's certainly a much more of a rotation at this point than it is a broad everything's ending sort of pattern.
Okay. All right. So David, anything else you want to go over before I ask you to show where people could find you and hear your commentary on stockcharts.com and go to your website? I think that your analysis is very clean and cogent, and your demeanor for presenting it gives, kind of soothes people's wild emotions of risking money. So you have a great bedside manner for a technician.
I appreciate you saying that, and no, it's awesome to come on here, Dale. And I should thank you and make sure everyone knows you very kindly came on my show on Stock Charts TV a couple months ago. I think it was in July or August you came on, but it was a lot of fun to get. If people think that you're just really good at asking questions and interviewing, you are an incredibly knowledgeable and thoughtful investor. You show that on my show very, very well as a guest. So thank you for coming on and sharing some of your wisdom with the crew there.
It was a blast. I enjoyed it. I still drink from the Stock Charts coffee cup. So,
I would. So listen, I know the only thing I would say is with gold, I think a lot of people are wondering why gold is not behaving better. And I think from a technical perspective, again, I think the narratives, you can come up with a lot of narratives of what gold should do. I'm focusing on what gold actually is doing. And for me, it is still very much in distribution mode. And there are a couple of things. If you think about the S&P and how the whole year, the RSI kept coming down to 40 and never broke below it. And that was such an indication of the bull market phase. You have the opposite on the GLD over the last couple months. When it's tried to rally, the RSI is petered out at 60, which basically means this is more of a distribution pattern. And until you can break above the RSI 60 on a rally, it's telling you the momentum's just not there. We keep making lower lows. We keep making lower highs. And the last time it tried to break out was here in early September, and it was unable to eclipse the highs from July and August. So a chart with the pattern of lower highs and lower lows is still in distribution mode. I think gold is weaker rather than stronger until proven otherwise. You need to put in a higher low, and we just haven't done that yet. So I think it's still very cautionary here.
Okay. Yeah, I know you're a technician, David, but I wanted to ask you one thing. I've brought it up to a few analysts, traders, is that back in 08, 09, during the housing crisis, the Great Recession, a lot of the economic writers would bring up China that wasn't damaged. They didn't buy subprime mortgages over there, and they were still growing. And part of their narrative was because China was growing, besides what central banks were doing, it was going to be an engine of growth that would help pull us out of a recession. And now they're 1/3. So that was a while ago, right? 13 years ago. So they've grown since then. And now they're deleveraging. They're trying to control demolition on leverage to try and clean their, the debt up. So if they were able to pull us out of a recession, could what they're doing put us in one? They used to say, when America gets a cold, the rest of the world gets pneumonia. Well, if China has pneumonia, aren't we going to at least catch a cold here?
So I think you're hitting on a key point, right? The fact that the S&P is not too far off of all-time highs, the Nasdaq's not too far out of all-time highs. In China, we're looking at the FXI, which is one of the China ETFs. It's been in an established downtrend for most of 2021. That divergence, that dispersion between those two is not lost on me. We mentioned with gold and what the RSI is telling you, just look at the momentum that's just clearly sort of in a negative trend. The concern is how much that impacts, non-China markets, right? Sort of U.S. markets and elsewhere. Could it be a factor? Absolutely. And I think you're seeing that with cryptocurrencies, right? Is probably the most obvious example now of where you're seeing actions in China, directly impacting a market that we're looking at, and many younger investors for sure are actively looking at all the time. You're seeing broad distribution in the cryptocurrency space, and that's certainly impacting it. Could that see it? Absolutely.
Do you have a visual on the credit spreads, how they've blown out in China? I think they went to something like 14%, the credit spreads. I don't know against what, but I saw a chart where they hadn't been that high, hadn't blown out that high for It looks like it was the history of the whole chart. So do you think that, I mean, I guess maybe I'm a little bit more conspiratorial, but, I kind of think that this is also part of a geo plan to, first it's a virus, then it's a credit crisis. And I think they're more prepared to live with austerity. They've had more practice than the US, that maybe it's part of whatever they're doing to correct their debt situation could also weaken Western democracies at the same time.
I mean, I think that, how is it all going to impact the U.S. markets? I don't know that. What I do know, though, is that it's uncertain. This is uncharted territory, pun intended. And in markets, I've found don't tend to enjoy uncertainty. That is not sort of a bullish word that I would throw around. That's something that that causes markets to be, it causes volatility to increase, that causes fear to increase, that causes panic, as opposed to stability and sustainable uptrend. So I think the uncertainty of how that could impact things is the biggest concern. And I think it's the same challenge that I would put it in the same bucket with the Fed and changing their very accommodative policy, right? There's a scenario where the Fed can change and be a little less accommodative, still supportive, and the market overall doesn't get shocked. But there's also a very real possibility that this does not go well. And the moment that they stop buying bonds as aggressively as they've had, and the market realizes that is changing, that the market takes that as a huge negative and comes off, it's a risk. And I would encourage people to think, not just, especially now, not just in terms of return, not just in terms of potential upside, but in terms of risk and money management. And think about
the chaos and disarray at the Fed. Have you ever seen a Fed with this many scandals? And
right.
I mean, we're here trying to use our charts, and all they have to do is say, "Are you buying some more MBS today?" Right. So anyway, I think that's different. There's going to be a reorganization of the Fed, most likely. I don't think he'll be renominated. And anyway, let's see. China may be still steaming red shells at U.S. retaliation for the trade war and mercantilism. Okay, that's possible. But anyway, I'm thinking, instead of everyone out there with their binoculars looking for black swans, they ought to be looking for a dragon. So that's China.
Well said.
All right, David. David, where's besides Twitter at D Keller CMT? Where's the best place to? You want to show your stockchart.com where people could see you, and you have a great following there, or your website?
Absolutely. Yeah, it's great to join you, Dale, as always. If you go to stockcharts.com, that's where we live. Our goal is to sort of give you the tools you need to make better decisions. And we, of course, focus on the equity markets, but touch on other asset classes as much as we can. So that's a great place to get started. Stock Charts TV is where I host my Closing Bell show. So if the way I'm talking about these charts helps you understand things, then check it out. It runs every weekday live at 4 p.m. And then the other thing I would bring up is my YouTube channel. So go to Market Misbehavior on YouTube, and I post a couple videos a week, just sort of breaking down the market environment, giving a little more behind the scenes on some of these technical approaches we've been talking about today.
Yeah, nice, David. And David brings in some very insightful people as well. He's also, if you think David only answers questions, he knows how to ask them too. He's a very good host. So David, our mutual admiration club is drawing to a close today. Thank you so much for your giving nature to come and share what you're seeing and the changes you're seeing, and what may lie ahead for us as market traders, analysts, and gamblers.
Good to talk with you, Dale. Stay safe. All right.
All right, buddy. David Keller, everyone. All right. Everyone have a great day. You could join the team in 17 minutes for the morning edge. Make sure you shave so you have a nice edge on when you go there. And don't just count your pips, count your blessings, everyone. Adios. Thanks for your attention today. We'll see you.